There is a quiet machine moving money right now, and most individual investors do not understand how it works. That machine is making some people richer while leaving many retail investors trapped in the same crowded places, staring at the same famous stocks and wondering why the index no longer seems to reward them the way it did before. Money is quietly rotating out of the sectors everyone keeps talking about. It is moving into areas that many ordinary investors have barely looked at. That is how markets usually work near important turning points. The change does not begin with a headline. It begins with flows. If you miss that rotation, you can spend the next year watching the index move sideways while a smaller group of stocks quietly moves with real force. If you see it early enough and manage your risk properly, you give yourself a much better chance of outperforming the market without gambling, chasing memes, or pretending you can predict the future. That is the key distinction. I do not believe successful investing is about predicting perfectly. It is about understanding the environment, seeing where the forces are moving, and positioning yourself with good risk controls before the crowd fully understands what is happening. By the time I am done, you will understand why the biggest stocks keep getting bigger, why the structure of the index naturally favors them, how money rotates between sectors, and which two specific areas are attracting capital. Right now, I will also walk through the exact type of framework I use to think about this. The framework is simple, but it is powerful. You begin with the world, then you look at sectors. Only after that do you look at individual stocks. Most people do it backward. They wake up, check the news, look at the same 10 famous companies and ask, what is moving today? That is a very reactive way to invest. It puts you behind the capital instead of in front of it. The better question is not which stock is exciting today. The better question is where the money is moving, why it is moving there, and whether that movement has enough force to keep going. Let me start with the bigger picture, because if you do not understand the weather, you will dress for the wrong season. Think of the economy and the market like weather. Sometimes there is sunshine, sometimes there are clouds. Sometimes a storm is forming before most people are willing to admit it. Your job is not to predict every drop of rain or every gust of wind. That is impossible. Your job is to look at the conditions that already exist and dress for the weather you are actually in. That is how I think about markets. I do not need to know everything. I need to know enough about the environment to avoid being positioned for the wrong world. What is the weather now? The world is worried about inflation. It is worried that interest rates may not fall as quickly as people hoped. Governments are spending heavily. Central banks are still important actors. Geopolitics is unstable. Energy security matters again. Oil matters again. Minerals matter again. Defense matters again. Supply chains matter again. To many people, that sounds complicated, but the basic principle is not complicated. This is not 2021. In 2021, almost everything went up. When liquidity is everywhere, people mistake a rising tide for skill. You could buy many things and feel like a genius. The environment did a lot of the work for you, but in a different macro environment, what you own matters more than simply being in the market. When the weather changes, different sectors need different clothing. Some businesses are dressed for easy money, some are dressed for inflation, some are dressed for energy scarcity, some are dressed for government spending, some are dressed for a world where security and infrastructure matter more than speed and stories. That is where the opportunity begins. The market is not one single thing. It is a collection of different systems. Capital is always moving between those systems. It goes from expensive to cheap, from crowded to uncrowded, from loved to unloved, from old winners to new winners, from yesterday's narrative to tomorrow's necessity. Many investors do not see that. They look at the market as if it is just the S&P 500 going up or down. That is too simple. It is like saying the economy is good or bad without asking which parts are gaining strength and which parts are losing it. Right now, the important point is that the old habit of buying anything and assuming the index will take care of the rest is not enough for everyone. It may still be fine for some investors depending on their goals and time horizon, but it is not the same thing as understanding where capital is moving. I am not giving financial advice. I am explaining how I think about the system. Each person must make decisions based on their own circumstances, risk tolerance, time horizon, and understanding. But if nobody has explained this machine to you before, it is worth paying close attention. The S&P 500 is often described as if it gives you broad exposure to the American economy. In one sense, it does, but structurally, it is not equal exposure. It is a market capitalization weighted index. That means the larger a company becomes, the more weight it has in the index. And when more money flows into index funds, more money automatically buys the largest companies. The bigger the company, the more of every passive dollar it receives. That creates a feedback loop. If one company is 10 times bigger than another, it receives roughly 10 times more of the automatic buying from a market cap weighted fund. That is not because someone sat down and made a fresh judgment about its future that morning. It happens mechanically. The index structure itself sends more money to the biggest names. Passive investing has become enormous. Retirement accounts, pension plans, ETFs, automatic contributions, model portfolios, all of it sends a steady wave of demand into the largest companies in the index. That wave has helped make the biggest companies even bigger. This does not mean those companies are bad. Many of them are extraordinary businesses, but it does mean the index is more concentrated than many people realize. A small group of companies can represent a very large portion of the index. When those companies are winning, the index looks strong. When those companies stop leading, the whole index can feel heavy, even if other areas of the market are quietly improving. This is the part many retail investors miss. They believe they are buying the market. In practice, they may be buying a large concentration of the same mega-cap winners everyone else owns, that can work beautifully when the flywheel is turning in their favor. But when the flywheel slows, the investor can feel stuck without understanding why. The structure is convenient, cheap, and easy. Those are real advantages, but the same structure can also create hidden risk. It sends billions of dollars into the same large companies again and again. Those stocks can rise for a long time. But when leadership changes, a passive investor may not notice the change until much later. Sophisticated investors understand this. Some deliberately buy even more concentrated exposure when they want that kind of mega-cap exposure. They understand what they are doing. They know they are choosing concentration. The problem is not concentration by itself. The problem is unconscious concentration. If you own the largest stocks because you understand the exposure and want it, that is one thing. If you own them because nobody ever explained how the index is built, that is another. This is why understanding money rotation matters. Most people watch the same famous stocks. They watch the same technology names, they watch the same headlines, they ask whether one megacap will beat another megacap. But the more important movement often happens below the surface. Institutional money does not sit still forever. It rotates. It moves from megacaps to beaten down sectors. It moves from technology to energy. It moves from popular trades to unloved trades. It moves from expensive assets to cheaper assets. It moves from crowded places to places where the next imbalance is forming. The job is not to guess which famous company will be the star every week. The job is to follow the money. That phrase sounds simple, but it is a complete way of thinking. Follow the money means you do not begin with a story you want to believe. You begin with the flow of capital. You ask where the forces are going. You ask which sectors are getting stronger while most people are distracted. You ask which industries are benefiting from the macro environment rather than fighting it. The media usually tells you late. By the time a sector is obvious to everyone, the easy part may already be gone. That does not mean the opportunity is over, but it does mean the risk and reward have changed. So the process must be disciplined. I start with the weather report. Where are we in the world? What are the big forces? Inflation, rates, energy, minerals, defense spending, government financing, supply chains, AI power demand, geopolitical tension. I do not need a 50-page academic paper to begin. I need a clear understanding of the environment. Then I look at the sectors. Which areas are filling up with money? Which areas have the strongest tailwinds? Which sectors are showing evidence that capital is moving in? Not just people talking about them. Only after that do I look at stocks. That order matters. Most investors begin with a stock. They hear a ticker. They get excited. They try to build a reason afterward. That is dangerous because it lets the mind fall in love with an answer before it has understood the question. The better order is world sector leader. You understand the world. You rank the sectors. Then you look for the strongest leaders inside the sectors where money is moving. This kind of framework can work in different environments because it does not depend on one prediction. It works in bull markets, sideways markets, difficult markets, political markets, and inflationary markets. Because it is based on adaptation. Markets are adaptive systems. Money moves, leadership changes. The investor who refuses to adapt usually ends up defending yesterday's answer. Let me show you one sector that fits the environment right now. The way to think about it is picks and shovels. In a gold rush, the richest people are not always the miners. Sometimes they are the people selling the tools, the equipment, the infrastructure, and the services that every miner needs. When a whole system needs to build, expand, repair, or extract more, the businesses that provide the machinery can become very important. In oil and gas, there is a similar structure. There are the producers, the companies that drill for oil and gas. Then there are the companies that sell the equipment, build the infrastructure, provide the compressors, supply the complex tools, maintain the systems, support pipelines, and make it possible to get energy out of the ground and move it where it needs to go. That second group is often less glamorous. But glamour is not the goal. Cash flow and capital movement are the goal. I see money rotating into oil and gas machinery and services. The reasons are not mysterious. The world needs energy. AI requires enormous amounts of energy. Data centers require power, cooling, grid capacity, backup systems, and long-term energy planning at the same time. Geopolitical instability makes energy security more valuable. When supply routes become uncertain, countries and companies think differently about storage, infrastructure, domestic production, and redundancy. When energy prices are higher or when supply security becomes more important, companies in safer regions may spend more to drill, build, repair, and expand. That can benefit the machinery and service companies that support energy infrastructure. Liquefied natural gas is part of the same logic. LNG is a major energy theme for the coming decade. It requires terminals, pipelines, export infrastructure, compressors, and specialized equipment. The more the world needs flexible energy supply, the more valuable that infrastructure becomes. This is not just an oil price story. It is an infrastructure story. It is a security story. It is a demand story. It is a capital spending story. That is why the machinery companies can matter so much. One company on my watch list in this area is Baker Hughes, BKR. The basic idea is straightforward. It is a major oil field services company, a picks and shovels business for oil and gas. It is not just betting on one well or one field. It provides tools, services, and equipment to the broader energy system. When I look at a company like this, I am not simply asking whether I like the story. A good story is not enough. I ask whether the chart and the flow confirm that capital is paying attention. I want to see consolidation. I want to see a period where the stock moves sideways, where weak hands are shaken out, where the market digests previous moves, and where a clear level begins to matter. Then I want to see a break above that level with evidence that institutions are involved. That is counterintuitive to many people. They think the only smart way to buy is to buy something cheaper. But in this kind of approach, the goal is not to buy because it is lower. The goal is to buy when the probability improves. Sometimes that means paying a little more after the market proves that demand is strong. This is not about chasing blindly, it is about waiting for confirmation. There is a big difference. A stock that moves sideways and then breaks above prior resistance is showing that the balance of supply and demand may be changing. If the breakout is supported by volume, it suggests that larger buyers may be involved. That does not guarantee success, but it changes the odds. That is why a company like BKR becomes interesting in this framework. It sits in a sector with macro tailwinds, and the price action can show whether money is confirming the thesis. Another company in that broad energy infrastructure area is NPK. It is a smaller player. It provides temporary worksite infrastructure for energy and construction projects. It is not the same kind of giant as Baker Hughes, and smaller companies can carry different risks. But the logic is related. If energy and construction activity rise, companies that provide infrastructure and support can participate in that spending cycle. What makes a smaller company interesting is not simply that it has gone up. A stock being up a lot does not automatically mean it is too late. It can mean the market has discovered something real, but it also means you must be more careful about entry, risk, position size, and confirmation. In this case, the pattern I care about is again the same. I want to see the heartbeat of the stock. I want to see the highs, the lows, the sideways action, and the level where a real breakout would matter. When a stock has gone sideways for months and keeps testing similar highs, that level becomes important. If it breaks through, the move can attract more capital because many investors are watching the same structure. The specific number is not the main lesson. The main lesson is the behavior. I am not interested in buying something simply because it is a good story. I am interested when the price confirms that money is starting to agree. That is the Wall Street logic many people misunderstand. Paying slightly more can be rational if it means you are buying after confirmation rather than guessing before it. But this only works with risk management. Without risk management, a breakout becomes just another excuse to speculate. The second sector I am watching is even less familiar to many retail investors. It is mining, quarrying non-metallic minerals and critical minerals. That does not sound exciting. It does not sound like a viral technology story, but markets do not reward excitement. Markets reward the places where demand, scarcity, policy, and capital flows come together. The world is becoming more electric. Electric vehicles need lithium and other materials. Batteries need minerals. Solar and wind require storage because the sun does not shine at night and the wind does not always blow. Grid modernization requires materials. Defense systems require materials. AI data centers require huge amounts of power and cooling. And the infrastructure behind that requires materials too. On top of that, countries do not want to depend on hostile or unstable foreign suppliers for critical minerals. That creates another layer of demand, not just from consumers or companies, but from governments. When a government says domestic mineral supply chains matter, that changes the system. It means the sector is no longer just a commodity story. It becomes a security story, an industrial policy story, and a supply chain story. That is why minerals and mining deserve attention in this environment. Again, I am not beginning with the ticker. I am beginning with the force. The force is that the world needs more of these inputs than many investors have fully appreciated. The force is that energy, AI, defense, electric systems, batteries, and grid modernization all point toward the same bottleneck. The force is that domestic supply and strategic security are becoming more important. Once I understand that, I can look for the companies in the space. One company in this area is SQM, Sociedad Química y Minera de Chile. It is one of the major lithium producers in the world. It has operations tied to lithium, and it has been working to expand capacity, including through relationships connected to Chile's state-owned mining interests and operations outside Chile. In a simple story, people say lithium demand rises, so lithium companies should rise. That is not enough for me. Commodity businesses can be cyclical, they can move sharply, they can disappoint people who buy too late or with too much confidence. So the right question is not whether lithium is important, It is whether the market is beginning to price a favorable shift in the right companies. That brings us back to the chart. If I see a sideways structure and then a move toward prior highs, I pay attention. If the stock can break above a level the market has already recognized, that can be a signal that the odds are changing. In the source structure, the interesting area was around the previous high near 95.5. Oh, the exact number is not the message. The message is that I would rather see confirmation than try to be heroic early. Many investors struggle with that because they have been trained to believe that paying less is always smarter. In reality, lower price is not the same as lower risk. Sometimes a lower price means the market is still rejecting the asset. Sometimes a slightly higher price after confirmation is a better risk because the odds have improved. That is a principle, not a prediction. Another company in the critical minerals and energy security area is UEC, Uranium Energy Corp. The uranium story matters because nuclear power is moving back into the conversation. AI data centers require reliable power. Electricity demand is growing. Countries want domestic energy sources. They do not want to depend on adversarial suppliers for critical fuel. That makes domestic uranium production strategically important. UEC has brought production online in South Texas, and the important idea in the source material is that it is connected to domestic uranium supply in the United States. It also has operations in Wyoming and processing capacity connected to uranium production. But again, the story alone is not enough. When I look at the chart, I do not see the perfect entry just because the theme is attractive. I see a stock that had a big rally, then a collapse, then a potential process of forming higher lows that can become interesting. But it may still be early. That is a crucial point. A watch list is not a buy list. Good investors separate attention from action. You can pay attention to an asset without owning it. You can respect a theme without rushing into it. You can say this may become very important, while also saying the price has not yet given me the signal I want. That kind of discipline is what keeps you alive long enough to benefit when the right setup finally appears. A third company in the minerals area is CMP. It is another play tied to minerals and the rare earth or materials theme. The idea in the original structure is that the stock appears close to a potential breakout area with interest around a higher level than where it was trading at the time. Once again, the important lesson is not to memorize a price. The important lesson is to understand why a price level matters. If a stock keeps failing near a certain zone, that zone becomes a test. When it eventually breaks above that zone, it tells you that the sellers who used to dominate that area may no longer be in control. If volume and sector flows support the move, the signal becomes more meaningful. That is how I think about these opportunities. It is not stock tips. Stock tips are dangerous because they give people an answer without a process. A process teaches you how to think, and the process is what matters most. You begin with the macro weather. You ask what kind of world we are in. Is it a world of easy money and universal growth, or is it a world of inflation pressure, energy constraints, strategic competition, and capital rationing? Then you look at sectors. You ask which sectors benefit from that world. You ask where money is flowing. You ask whether the sector is becoming stronger while most people are still looking somewhere else. Then you look at leaders and setups. You ask which companies in that sector are best positioned. You ask whether the chart is confirming the thesis. You ask where the risk is. You ask what would prove you wrong. Most investors skip those steps. They want the ticker first. They want certainty first. They want the reward without the discipline. That is not how the system works. The system rewards those who understand causality. It rewards those who see the forces before they become obvious. It rewards those who size positions so that being wrong does not destroy them. This is where risk management becomes essential. If you are going to put money to work in individual stocks or sector themes, you must first know how much you are willing to lose. Not in theory, in real numbers. I like to think in terms of risk per position. A position may be larger than 1% of a portfolio, but the amount I am willing to lose on that idea can be controlled through entry, stop level, and position size. In the source framework, the idea was to keep maximum risk around 1% on a position. The principle is right. You should know the loss before you become excited about the gain. That is how you sleep at night. The mistake is to hear a theme like energy infrastructure or critical minerals and then dump too much money into it before you understand it. That is not investing. That is emotional transfer. You transfer excitement into position size, and the market punishes that. Eventually scaling matters, learning matters, watching matters, risk control matters. You can express a sector view in different ways. You can use individual stocks if you understand them. You can use funds if you want broader exposure. You can do nothing until you understand the space better. All of those can be rational depending on the investor. The key is to avoid confusing a good theme with an automatic investment. A good theme still needs a good process. Imagine the market as a chessboard. Each square is a sector or industry. One square might be software, another might be oil and gas services, another might be uranium, another might be gold miners, another might be critical minerals, another might be healthcare, another might be electronic components, another might be insurance. Money moves across that board when money leaves one square and enters another. The price behavior changes. The sector that loses capital may stop working even if the companies remain famous. The sector that receives capital may begin working even if most people still think it is boring. This is why looking only at the index can mislead you. The index may be flat, but beneath the surface one sector may be strengthening while another weakens. The index may look weak, but certain sectors may be doing very well. The index may look strong, but the strength may be concentrated in a handful of names. That is why the question is always, where is the money moving? If oil and gas services are receiving capital, that matters. If construction-related companies are receiving capital, that matters. If insurance or healthcare or electronic components are receiving capital, that matters. If defense was strong before and mining was strong before that, it tells you something about how quickly leadership can change. The point is not that one sector stays the winner forever. The point is that money rotates. You do not marry a sector. You follow the flow as long as the flow remains. If the money leaves, you leave with it, or at least you reevaluate. Sometimes a position lasts a year or two, sometimes it lasts a month or two. The duration should come from the evidence, not from your ego. That is one of the hardest things for retail investors to accept. They want an identity. They want to be a tech investor, a dividend investor, a gold investor, a growth investor, a value investor. There is nothing wrong with having a style. But when identity becomes stronger than observation, people stop seeing reality. Markets do not care about your identity. They care about liquidity, earnings, expectations, rates, policies, supply, demand, and human behavior. The best investors I know are not stubborn in the way most people think. They are principled, but not rigid. They have rules, but they adapt to evidence. They understand that the world changes in cycles. That is why I keep coming back to the weather. You do not wear the same clothing in every season because you love the clothing. You wear what fits the season. The investor S equivalent is owning what fits the environment, while always knowing what would tell you the environment has changed. The old world of easy money made many people overconfident. It taught them that buying the biggest names and waiting was always enough. That may still work over very long horizons for some people. But if your goal is to understand where opportunity is forming now, you need to look underneath the index. You need to look at the flows. You need to look at sectors most retail investors have ignored. You need to look at the picks and shovels behind the obvious stories. AI is an obvious story. Energy for AI is less obvious to many people. Power infrastructure is less obvious. LNG infrastructure is less obvious. Oil and gas service machinery is less obvious. Electric vehicles are an obvious story. Critical minerals are less obvious to many people. Grid modernization is less obvious. Domestic mineral supply chains are less obvious. Uranium and nuclear fuel are less obvious. Often the real money is not in the front of the story. It is in the bottleneck behind the story. That is where the picks and shovels idea becomes so useful. When everyone is talking about the miners in the gold rush, I want to know who sells the tools. When everyone is talking about AI, I want to know who provides the energy, materials, cooling, and infrastructure. When everyone is talking about electrification, I want to know who controls the inputs. When everyone is talking about national security, I want to know what domestic supply chains become non-negotiable. That is not complicated, it is cause and effect. But simple does not mean easy. It is emotionally difficult because it requires looking away from what is popular. It requires patience. It requires doing the work when nobody else is interested. It requires waiting for confirmation rather than needing to be early for the sake of being early. Many investors would rather buy what everyone already understands. That feels safer. But the market often makes obvious safety expensive. The opportunity is usually where something is becoming important before it becomes universally comfortable. That is why I am watching oil and gas machinery and critical minerals. I am not saying every stock in those sectors will rise. I am not saying every breakout will work. I am not saying these are risk-free opportunities. There is no such thing. I am saying that the macro weather, the capital rotation, and the sector logic make these areas worth watching. With a disciplined process, the market is a machine of probabilities. The investor's job is not to be certain. The investor's job is to find situations where the probabilities, the risk, and the potential reward make sense. That means asking hard questions. What is the macro force? Which sector benefits from that force? Is money actually moving into that sector? Which companies are leaders or beneficiaries? Is the chart confirming accumulation? Where is the breakout level? Where am I wrong? How much can I lose if I am wrong? Can I sleep if the position moves against me? Those questions keep you grounded. Without them, investing becomes entertainment. And entertainment is expensive when you confuse it with a plan. This is also why I do not like the habit of staring at the same index every day and letting it tell you whether the market is good or bad. The index is useful, but it is not the whole truth. It can hide concentration, it can hide rotation, it can hide opportunity. It can hide risk. If the top 10 companies are carrying the index may look healthier than the average stock feels. If those companies stop leading, the index can look weak while money moves into less familiar areas. If you do not understand that, you may think nothing is happening. In reality, the money is moving right in front of you. That is the quiet machine. It is not quiet because it is hidden by law. It is quiet because most people are not trained to listen to it. They listen to headlines. They listen to opinions. They listen to arguments. They listen to personalities. Flows speak more softly, but they matter more. The disciplined investor learns to listen for them. That does not require 20 hours a week. It does require consistent attention. Even an hour a week spent correctly can change the way you see the market. You can review the macro weather, you can rank sectors, you can review charts, you can update your watch list, you can ask whether money is still entering or beginning to leave. If someone works 40, 50, or 60 hours a week to earn money but spends no time learning how that money moves, there is a mismatch. Earning money is one part of the game. Managing capital is another. And managing capital begins with understanding that capital is not static. It flows, it moves from one place to another. It moves because the world changes. It moves because expectations change. It moves because policy changes. It moves because scarcity appears. It moves because risk changes. It moves because human beings chase, panic, rotate, and adapt. The investor who sees only the surface will always feel confused by the movement. The investor who understands the machine can at least begin to respond rationally. So the takeaway is not simply Baker Hughes, NPK, SQM, UEC, or CMP. Those are examples inside a process. The real takeaway is the process itself. Do not start with the ticker. Start with the weather. Do not chase the famous names just because the index gives them weight. Understand what you own and why. Do not assume a sideways index means there is no opportunity. Look underneath it. Do not buy a sector because it sounds exciting. Watch whether money is flowing into it. Do not confuse a watch list with a buy list. Do not put on a position without knowing how much you can lose. Do not try to be right all the time. Try to build a system that can survive being wrong. That is how serious investors think. They do not need to be smarter than everyone else. They need to be more disciplined than most people. They need a better map. They need principles that keep them from reacting emotionally to every headline. Right now, the map points to a world where energy, infrastructure, critical minerals, uranium, and supply security matter more than many investors realized a few years ago. That does not mean the old leaders vanish. It means leadership can broaden, shift, and rotate. It means the next opportunity may not look like the last one. It means the market may reward people who understand the underlying forces rather than those who only follow the most popular story. The rich often get richer not because they have a magical prediction, but because they understand the machine earlier. They understand how passive flows concentrate money. They understand how institutions rotate between sectors. They understand that capital has seasons. They understand that the biggest risk is often owning something unconsciously. Retail investors can learn the same logic. They do not need to gamble. They do not need to chase. They do not need to believe every hot stock story. They need a framework. The framework is simple enough to remember: read the weather, follow the sector money, then study the leaders. That is the system. And in the current weather, the two areas worth watching closely are the machinery and infrastructure behind oil and gas, and the critical minerals and uranium chain behind electrification, AI power demand, defense, and energy security. Some of the specific names to research include BKR and NPK on the energy infrastructure side, and SQM, UEC, and CMP on the minerals and uranium side. They are not instructions. They are not guarantees. They are not a substitute for your own judgment. They are examples of how a framework turns a macro view into a sector watch list and a sector watch list into specific setups. The market will keep moving. The index will keep giving the biggest companies more automatic attention. The headlines will keep arriving late. The crowd will keep asking, which famous stock is moving today? I would rather ask a different question: where is the money going, before the crowd admits it? That question has saved me from many bad decisions and helped me find many better ones. Because in the end, investing is not about being entertained by the market. It is about seeing the system clearly enough to make good decisions, manage risk, and stay in the game. When the money is still flowing, you can ride with it. When the money leaves, you must be willing to change. That is not weakness, that is principle. Follow the money, follow the system, control the risk, and never confuse a popular market with a safe one or an unloved sector with a dead one. The next big opportunity often begins quietly. By the time everyone is talking about it, the quiet machine has already been working for a long time.